The much anticipated CPI number came out this morning, and it came out at 8.5% year over year. That is flat with the previous month, and we did not have further acceleration. The hope is that inflation has peaked. To keep in mind, inflation has been accelerating for the past couple years coming out of the COVID crisis, where you had a disinflationary or deflationary event where demand temporarily stopped, and then prices had ended up having a big pullback. But we've accelerated out of that, and the 8.5% level is near 40-year highs. So this is a very high level of inflation, and one that is destroying or hurting real wages. So real wages are running negative, meaning that people are getting smaller pay increases than the rate of inflation over the past year. That is very negative. My anticipation is that labor will push back and demand pay increases to match inflation. And as that occurs, you're going to begin to see some wage price spiral occurring, where wages go up and companies raise their prices to offset the increases they've had to pay for wages. So this cycle looks like it's well underway, and there's going to be a significant push by labor to increase their wages here over time. The other thing to keep in perspective is inflation is primarily a result, in my opinion, of the outsized quantitative easing for infinity that we've had. You go back to 2007, the Federal Reserve balance sheet was around $800 billion. And then we started quantitative easing. We had quantitative easing 2. We had a quantitative easing 3, which I called Qfinity at the time. The Federal Reserve governor out of Dallas, Fisher, came out and said that this is like a Hotel California moment. Yes, we can begin this easing process, but we're never going to be able to reverse it. And here we are, 15 years later after quantitative easing began, 14 years later after quantitative easing began, we have a situation where we're going to try to start quantitative tightening. We've started a couple times in the past and have retraced. Currently, the balance sheet is at 8.9 trillion. So we went up from 800 billion to 8.9 trillion, an 11-fold increase in 14 years. We have started the quantitative tightening process very reluctantly. The 8.9 trillion balance sheet has shrunk by 72 billion. So as you can see, that's a insignificant, less than 1%, impact on the balance sheet. So although quantitative tightening is all the talk, there are some doubts that the Fed will follow through on this on a sustainable basis. We've already seen a reaction with mortgage rates as the Fed stopped buying mortgage bonds. Those rates shot up. That has cooled the housing market and the refinancing market, straining consumer finances. In addition to that, the inflation is causing consumers to have to spend more money on needed items, less money on consumer discretionary. You're beginning to see a hit in numerous consumer discretionary areas. So inflation not only reduces the value of your dollar, it ends up following through to having a negative impact on economic activity as well. So we are officially in a recession. We've had 2 quarters of negative growth. I would anticipate that, yes, although we might be flat for the next couple of quarters, that as this inflationary spiral works its way through the economy, causing consumption to sort of stagnate and interest rates to rise, that will have further negative impacts on the economy. So I do not think we are out of the woods on the economy, and I do not think we're in the midst of a recovery after a short, shallow recession, but I do think we're just at the beginning. In addition to that, interest rates have been manipulated down by quantitative easing. The Fed has been buying bonds at a rapid pace, irregardless of market conditions and inflation. And bonds generally sell at 2 or 3 points above the inflation rate, or they also sell at nominal GDP. So we could easily argue that the 10 and 30-year Treasury bond, if they're market-based pricing, should be over 5%. We have the additional element that the Chinese are probably going to start reducing aggressively their Treasury holdings, given what's occurred with Taiwan. I would expect some economic warfare on that side. That will also be a pressure on higher interest rates, coupled with inflation, coupled with tapering, meaning that the Fed's not going to be buying bonds. So I would expect interest rates to move up from here. All in all, we have entered an unprecedented period in the economy with quantitative tightening coming after this huge quantitative easing. 800 billion to 8.9 trillion is unprecedented. For anybody to tell you with any sense of authority that they know what's going to happen as this plays out are kidding not on themselves, but they're lying to you. Nobody really knows how this is going to play out. We don't know when and if the Fed's going to pause or if they're going to follow through on quantitative tightening and actually reduce their balance sheet. The outcomes from those two choices are going to be very different. So I can only say you need to monitor the situation. We are monitoring the Federal Reserve balance sheet closely. We check it every week to see what the numbers come out as soon as they come out to see where we are. But we do think that the Fed is going to be a big swing factor. They say they're going to follow through on quantitative tightening. They indicate in their discussions that they're going to be raising rates as well. I think there's going to be a lot of political pressure as quantitative tightening really kicks in, as the Fed's balance sheets begins to roll off in earnest, that you're going to have a lot of pressure by the politicians on the Fed to reverse course or at least pause on quantitative tightening. But that's my guess, and make no doubt that is a guess. Nobody really knows what the Fed's going to do, probably including the Fed themselves. So with that, please take a look at our website, buildingbenjamins.com, where we have more information about my stock picks that I've had from my own portfolio. We have a full disclaimer that explains that this is not investment advice, but merely what I'm doing for my portfolio. You can also sign up for an email alert that will provide you with timely updates and also let you know when I buy or sell something in very short order, as opposed to having to wait for a video or a written report to pop up on the website. So please take a look at that and sign up. Thank you for your time. This is Ben Halliburton, and I hope you have a great day. Thank you.